Hello and welcome, dear friends. I'm sorry there was some technical hiccups and we could not start on proper time. But I hope things are now sorted out. And we are starting today on 2nd of June. And myself, Shumai Goswami, and I welcome you all again to Proficient Group. As you were aware that for the past couple of weeks, we were talking about momentum oscillators, and today we are continuing with that topic, momentum oscillators. In our earlier sessions, we talked about mainly with various kind of trading signals in MACD and how MACD derives its signals by crossovers of the signal line, the zero line, and also with divergences. So today we will be talking about a new kind of momentum oscillator, which is called KST. As per Martin Prince's classification, KST stands for no sure things. Now, no sure things. The name is slightly misleading because there is nothing called sure things as far as the uncertainties in financial markets are concerned. But still, this momentum oscillator will help us to gain some insight and some considerable amount of insight into what is happening in the beneath the surface of the particular stock. One of the main characteristics of momentum oscillator is that whatever is not seen by naked eye, by only looking at the price, becomes relevant, becomes open, and we can analyze the inherent strength and weakness of the bulls and bears, and with that insight we are able to make an opinion about whether the trend is more likely to continue or it is more likely to reverse. So that is the basic characteristic, that is the basic objective of the momentum oscillators, but we can also use it in many other ways to find out what is the trend and where we can enter or exit during a particular trade and all those things. So let's come to today's topic. What is actually KST? Now, KST is nothing but a combination of ROC oscillators. We have earlier talked about ROC oscillators. ROC actually rate of change, and today we are starting with ROC oscillators. Let's see, and from there we will go to the KST. So let us create first an ROC oscillator, right? And I am again defining what do we mean by an ROC oscillator. I'm just giving it a name, Proficient ROC, right? Now, ROC change stands for rate of change, C, 20, percentage. So this is simply the syntax of rate of change oscillator, which C stands for the closing prices. Whatever calculations I'm doing here is all based on closing prices, 20-day closing prices. The 20 stands for 20 periods. In daily time frame, it is 20 days. In weekly time frame, it is 20 weeks. So 20 is the time period if we are running it on daily time frame. Especially we will be doing all these analysis on daily time frame. And percentage means what is the percentage change in closing prices in those 20 periods, right? Say for example, if prices of a particular instrument was 100 20 days ago, and today it is at 105, we can say that the rate of change is 5%, and only the reading 5 will be given. And it is a continuous line. We will get a continuous line. So every day we will get a new value of the 20 period ROC, and let's first see how it will look on chart. So this is the rate of change oscillator we have plotted here. It is a 20 period oscillator. I'm just changing the color and making it a bit bold so that it is easily visible to you all. And this does not say much unless we are plotting here a zero line, right? Say, let's plot a zero line here. So we were plotting a horizontal line, which is the zero line. And this zero line gives the value of no change. Now, comparing with this zero line, we can say where is the prices, right? Say, for example, last value is 0.73. That means ROC has changed only. The prices of Nifty, this is the daily chart of Nifty, has changed only by 0.73% over the last 20 period, right? Now, here is an important conception, which is the cyclicality. That is, market is composed of various cycles, right? Cycles means prices are going up, then coming down, and then again going up. So these two phases consist of a cycle, and these cycles can be from a very small time frame to a very large time frame. A cycle can be consisting of only 1 minute to 1 year or 10 year or whatever, right? Market is composed of n number of such cycles when prices go up and then retrace entirely and then go down and then retrace again completely. Now, the magnitude of these rises and falls may not always be equal, and that is evident, and that is what that is the reason behind the trend why prices keep on continuously rising or keep on continuously falling. But within those rises and falls, prices keep oscillating, and it is these oscillations that we will see the small cycles or the big cycles, right? So there is no doubt that prices will show cyclicality, will show some oscillatory nature. And the important fact to note here is that there are various time frames, or there are various, we can see, time periods, to be more specific. Time periods is the time required for one cycle to show up, right? So since market is actually consisting of several time periods, there is no reason that we can we can see all these time periods with only one ROC. The ROC that we have plotted here shows only 20 period, right? Now, who says that there is only a 20 period ROC that can reveal all the bull and bear cycles? There is no reason to believe that, right? Here I will tell you one thing is that the 20 period ROC is best to find out cycles which consist of 40 days, right? A 40-day cycle is best revealed by a 20 period ROC. And like this, if there is a 100-day cycle, we will require a 50-day ROC to find that, right? This is a bit theoretical in nature, but this is very important. Most of the time, we cannot find out what will be the true length of a moving average, or what will be the true length of an RSI or stochastic that we should be using for our particular purpose of trading. Now this knowledge will become very handy, that whatever be the time period that you oscillate to take advantage of, time period of the cycles, definitely you should always use an indicator which uses a length of half of that cycle. If there is a cycle that you can see which consists of 200 days, then I will suggest you to use a 100-day moving average or 100-day ROC, like that. So coming back to our topic, we can see there are a number of cycles in the market, right? And only one ROC is not sufficient to reveal all those cycles, right? So this is a short-term ROC. 20 period I consider as a short-term ROC. We are going to construct two more ROCs, right? One is the intermediate term and one is the longer term. This is in congruence with Dow theory, right? According to Dow theory, there are basically three kinds of trends: primary, secondary, and short term. And we are going by that logic, and we are trying to construct three different ROCs to reveal the trends and the entry and exit points within the trend, right? So here we go. I am naming it Proficient ROC1, and I am going to construct two more ROCs. Proficient ROC2, which is nothing but I am using a 50-day time period for intermediate term ROC, right? C, 50, percentage. I'm ending it, and I also want a zero line. So here we go. Now, here is a little observation that I will draw your attention to, is that this is the middle pin, which is in the blue. This is also an ROC, and this is surely less volatile in nature, right? As you can see, the green ROC, which is the 20 period ROC, is more volatile. You can see in this period, when ROC actually came below the zero line, and in recent period it has again gone higher. But the 50-day ROC has not come below the zero line, right? So this is an important criteria. The 50-day ROC is less volatile, and therefore it is more efficient to point out the nature of the trend, right? This is only the intermediate term ROC, and right now we are going to plot the longer term ROC. I'm using 100 days as the time period for the longer term ROC, and I'm also using the percentage terms along with the zero line. So here is the 100-day ROC, as you can see on my chart, and that is drawn in red. And with this, we have calculated the ROCs of 3 different time periods, right? Uh, that actually takes care of the primary trend, the intermediate trend, and the short-term trend. The primary trend continues to be upward as the ROC in red, which is the 100-day ROC, that is in positive territory. And in fact, right now, all the trends are upward in nature. Now, these things are pretty clear, and nothing difficult is there, but I will draw your attention to the exceptionally strong bull market that we saw in 2016 and 2017. And you can see from this diagram that as long as the prices were keeping upward, prices rose in an uptrend, the red ROC, which is the longer term ROC, never ever crossed the red line. They never ever crossed its zero line. So these long-term ROCs are really good at spotting the longer-term uptrend, right? And within this uptrend, a general idea, as I have many a times conveyed, that whenever prices show some sort of weakness, like here, when prices are showing some pullback here, because longer-term ROC is in the positive territory and the short-term ROCs have crossed below the zero line, these are opportunities to go long. These are the opportunities to enter in the direction of the primary trend, right? These will give you low risk trading opportunities. These low risk trading opportunities do not come every now and then. These come only 3 or 4 times in a year, but when they present themselves, they are excellent trading opportunity, right? Another same thing happened here again when the longer term trend was in the positive territory, but the short term trend, look at the green ROC, was in the zero, was below the zero line, showing it is right now Nifty was showing some weakness. So this was another opportunity when you could have taken a trade in the direction of the primary trend, and that even during a weakness. Same thing happened here. Here that the ROC was below, longer term ROC was above its zero line, which was showing that it was a primary uptrend and the uptrend was continuing. But look at the short term green ROC, which is the 20-day ROC. This short term ROC was below the zero line. So this again showed another trading opportunity, right? So these are the trading opportunities, and as long as the trend is up and the short-term ROCs keep coming down, we will have some trading opportunities, and opposite things are also true. Suppose look at this particular period, the December or the end of 2016. When you can see ROC to come to the zero line, to come below zero line here, right? The longer term ROC, that is what I'm talking about. But the short term ROC, you can see here, is again going above the zero line, right? So the long-term ROC is below the zero line, which shows this is the beginning of a new downtrend, and the short-term ROC, which is the 20-period ROC, is going above the zero line, which says this is a pullback. So this pullback is now a shorting opportunity. That is, we can take a direction of the primary downtrend here, and we are getting higher prices to sell. So this is the basic philosophy that I have been told you in several of our past webinars that you have to take a trend, you have to take the trend in the direction of the primary trend, but only when there is a short-term pullback in the opposite direction, because that kind of pullback will give you a low risk trading opportunity. If you sell it here, suppose if you sell it here, where will be your stop loss? Your stop loss will be just here, the previous high. If the previous high was taken out, then this pullback is likely to be a false one. So this much is only your stop loss. And on the other hand, previous bottom where prices made a bottom, this bottom is likely to be exceeded for the downtrend to continue. And this is where you can sell your, this is where you can exit your position, short position. So on a theoretical basis, on empirical basis, this is the trading idea for ROCs. Like we have created 3 different time frames of ROCs, and we are getting our signal from the ROCs. The objective of this webinar is to create a KST, which is the abbreviation of a momentum indicator, momentum oscillator, according to Martin Pring. Martin Pring has written many excellent books on technical analysis, and you can get his ideas on from the book on momentum indicators, and also technical analysis explained. Both books are written by Martin Pring, and you can get his ideas. And the KST conception is given there. Now I'm going to construct KST from these ROCs. What is the idea? The idea of KST, no sure thing, is to merge all the ROCs of these varying time frames into one single ROC, and that ROC will then be called as the KST, right? So let us take only one ROC, which is the 50-day ROC, and we are tinkering with this formula. We are adding up, right? We are just adding up the 3 ROCs we have created here, 20, percentage plus okay. So we actually have summed up all the ROCs, and this forms the basic idea of KST, but this is not the KST as yet, because in this formula, whatever we have done so far in this formula, it will give us an equal weightage, right? An equal weightage of all the ROCs, which is not the case in real life. In real life, we want to give more weightage to the long-term ROC, and we want to give least weightage to the short-term ROC, right? So how could we give greatest weightage in the long-term ROC? We are multiplying the long-term ROC by 0.5. We are multiplying the intermediate ROC by 0.3. And we are multiplying the short-term ROC by 0.2. This actually means that we are giving the greatest weightage to the longer-term ROC. The 50% weightage is given to the longer-term ROC. 30% weightage is given to the intermediate ROC, right? And only 20% weightage is given to the short-term ROC. And this is the KST, right? This is the KST. So right now I am changing the name of this formula to coefficient KST. This is the KST indicator, no sure thing. When we have created 3 time frames for the ROC for a particular stock, and we are giving varying weightage to different time frames. We are giving the greatest weightage to the longer term time frame, we are giving least weightage to the short term time frame, and we are giving some intermediate weightage to the medium term time frame. And this is the construction of KST. Now we are going to construct the KST, and let's see how it looks. Okay, so this is the KST, and here we go. This is different from all other oscillators that we saw right now. All other oscillators have given their contribution to here, and as we can see that KST shows it is a good enough indicator, right? It is a reasonably good enough indicator to show you the trend directions in almost all time frames, right? The crossovers of the zero line is the most important signal that we convey here, but there is one important point that I will like to mention here. It is only a momentum indicator. Momentum indicators means it will give you the relative strength of the bulls and the bears, right? It is not a trend indicator. It is not a trend indicator like a moving average. It is only a momentum oscillator. Momentum oscillators are good in what respect? Suppose there is an uptrend and prices are making new highs, right? But only a momentum indicator can tell you, even if prices may be making new highs, but not necessarily the bulls are stronger than ever before, right? The bulls may be getting weaker and the prices may be going higher only because of some momentum oscillator, because of some inertia, right? Inertia of the past strength. So that is what a good momentum oscillator is supposed to tell us. This is what Martin Payne had given us, but I want to go one step further here, right? Let us create a more sophisticated version of KST. Let's see if we can do that, right? First of all, what we will do here, we are not going to plot here KST. We are defining the KST as a new variable. We are not plotting anything here. We have just given the ROC different variable, and we are not naming it here. So the KST goes, and then we will just plot the margins, the highest high value and the lowest low value of the KST of say 25 billions. So HHV A comma 25. A stands for KST. How does it look? So this is how it looks, right? And let's assign it the variable X, and let's introduce another variable Y, which will now tell us the lowest low value of the KST of the past 25 days. We do not need the zero line right now. And let's plot X, let's plot Y, and let's see how it looked like. So here are the two lines, and the KST, these lines actually show the greatest and the least value of KST of the past 25 days, right? Okay. You can do many innovative things with this KST. I'm just giving you a basic idea. And you can interpret these lines in many different ways, which will give you another insight into prices. What I'm suggesting you here is that we are not going to use the highest high value and the lowest low value of the KST, but we are just going to use a mean value of the highest high and the lowest low, and this will be our indicator. I'm just getting an average of these two lines, right? Yes. Here we go. This line is actually, I believe, is a more sophisticated version of KST. And this line, what does this line give us? The slopes are most important, right? Look at the slopes. Here is the slope of this line, KST line, increasing, and this slope is decreasing here. So this line most of the time remains horizontal. Look at the characteristic of this line. This line most of the time remains horizontal, but whatever is the slope of this line, this slope continues in its direction for pretty long time. So the downward slope changed from this, the upward slope changed here, right, on this particular day, and right now I am only using 50-day moving average. Why I'm telling you that I will come later. And as prices were making lower highs and lower lows in this period, the KST was also in a downward slope, as you can see. Now this downward slope changed only here, right? So from here we can see another change of trend. The previous trend here was downtrend, right? And the downtrend is the result of this uptrend. The downtrend came at the end of this uptrend. This uptrend in the price was traced in the upward slope of the KST here, and this upward slope actually reversed here, and this reversion means actually the beginning of a new downtrend. This downtrend remained effective as prices was making new lows, and the KST was making a downward slope, or its slope was downward, until on this day KST made a higher slope. And here the higher slope is continuing till on this particular date. So here we get a good trading opportunity from the long side, right? Prices showed some good appreciation here until this happened. So prices here made some pullback here. 2 weeks ago prices came down, and this came down was shown here on the downward slope of KST, and as of now the downward slope is in effect. So although prices have made some appreciation from there, but KST is not showing it. But sooner than later, maybe on Monday or Tuesday, we have to keep looking at this indicator, and whenever this KST shows its first reversal of slope, right? It's forced change of slope from downward to upward. That will be the beginning of a new trend, the new uptrend, right? And this will give us the basic idea of trend. But here again, I will draw your attention to one weakness of this particular momentum oscillator, because this momentum oscillator only gives us the strength of the buyers and sellers. So sometimes it will so happen that even if prices are making newer highs like here, this indicator will not show that, right? Even during an uptrend, maybe prices will be making lower highs. Prices will be making higher highs, but KST will be making downward slope. So this is the kind of signal that we don't want to see, right? From KST, we have to eliminate this kind of signal. In order to do that, we have to use a particular moving average, right? 100-day moving average is good enough for this, because this takes care of the longer term time frame. So the logic is that a downward slope in KST will be acceptable only if prices go below the moving average, right? Go below the 100-day moving average. Unless prices go below the 100-day moving average, the downward slope of KST will not be effective. And with this simple rider, you can eliminate lot of wrong signals, lot of whipsaw signals from the ROC. So what is our current situation? Price ROC KST is showing a downward slope, but prices are actually above this moving average of 100-day denomination. So whenever KST will reverse its signal, the signal from the actual permission from the moving average is already there. So that will be the beginning of a new uptrend. So this is how we can use KST. We constructed KST from the ROCs. Then we submerged all these KSTs in all these ROCs into a single KST, and we even sophisticated that KST to create trading signals by a combination of moving average and the slope of the KST. So I hope you liked the idea. I request you to do many more explorations, many more innovations like that. And if you come up with new ideas, you definitely share it with me. This video will be posted on YouTube as well, and you can give your feedback, you can give your ideas on KST with me, and if there is any query, please come back. I will definitely try to reply to your problems. So with this, we come to the conclusion of this part, and hope to see you next week. Goodbye.